Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're chatting with the management of Kalyan Jewellers. Joining me now is Mr. Ramesh Kalyanaraman, who is the executive director of the company. Thanks so much, Ramesh, for taking the time. And a strong set of numbers in the fourth quarter as well as the financial year, but I'm focusing specifically on the fourth quarter. Consolidated revenues up as much as 18%. Adjusted PAT is up as much as 32%. There's an exceptional item. So before we kick things off, perhaps we talk about these key headline numbers. What, according to you, stood out, and what is that exceptional item?
Yeah, so revenue was strong in Q4. We grew by around 17-18%, and that growth was in the range of 30%. And the one-time write-off is because of the sale of certain non-core assets like aircrafts, and that's a one-time write-off which has come in the range of 33 crore pre-tax.
Okay. So I was actually speaking to my colleagues in the newsroom that have tracked your company for a while, and those aircraft, I believe, were used by Mr. Kalyanaraman in the early days of the business, where he was going to areas that didn't have as much connectivity. So would it be fair to say that now that leg of growth has taken place, you all are comfortable with the network that you've built, and also India's infrastructure has gone to a point where you don't necessarily have to use your own aircraft?
No, so both are there. One, of course, the connectivity has increased, as all of us know. It's not like what it was in 10-15 years before. But over and above that, there are more capital light options also available these days. And so we wanted to try it out.
Absolutely. So let's talk about the business then. And I see, when I look at the split of the revenue, I see that there is a significant growth in the fourth quarter from non-South businesses, 38% revenue growth, whereas the South businesses have only grown about 4%. Why is there a disparity in the demand?
No, there are two things. One is that the expansion predominantly has been in the non-South region for the past, 1.5 years. That is one reason that the non-South revenue growth is very high when compared to South. And also, if you look at Q4, it is not actually a very big quarter for South India. Only a couple of years before, post-COVID, the Q4 revenue, there was a huge growth in Q4 revenue. And we were a predominantly South player then. So the base automatically became high. And that is the reason why the growth rate in South India when compared to the previous year is a bit, muted. Because Q4 generally is not a huge quarter for South India.
Okay. So then if you even it out over the course of, say, 3 or 4 quarters, or if you look at a full year basis, and I know that you've been expanding in non-South regions. So let's look forward to FY24 then and look at what the split is. Because I look at Q4 per se, and I see that non-South revenue is inching up towards the South revenue, which has been your stronghold. So obviously that seems to be part of the strategy. What can we look forward to in terms of the split between non-South and South in FY24?
Yeah, so it should keep going in this way because non-South expansion is going to be even stronger in the running financial year. We will be opening 52 new showrooms in this financial year in the non-South markets. And over and above that, we are planning to we are getting a lot of inquiries from South India for franchisee, which we are taking it up, and we are going to do a pilot phase of South franchise also within a span of 2-3 months. If that settles down, there will be a South expansion as well. So we will not be able to give a clean guidance on what the South non-South revenue is going to be, because there is going to be a South expansion as well, which is going to be planned in this financial year over and above the 52. But having said that, the South SSGs are going very strong as we speak for Q1. For the first 45 days in this year, the revenue growth has been extremely strong. Akshaya Tritiya has been strong, and it is much, much stronger than what has happened in Q4.
Understood. The reason I was asking this is to set the context for the next question, which is the growth in studded jewelry, which seems to be a reason, or which seems to be the case because you've expanded in the non-South markets. I think demand for studded is higher in those markets. Is that going to change the kind of dynamic for the products that you sell overall, the mix, the volume mix?
Yeah, so non-South as a market is more studded focused, okay, and that is why the studded ratio is moving. But over and above that, even within the south or within other parts of the country, we as a brand try to push studded because it comes with more margin.
Yes.
The product what you call positioning also changes. So there is an organic growth for the studded, as well as the studded ratio will go up further because the non-south expansion is going to be extremely big.
Okay. No, so what I was trying to get at is that FY24, you've said that you can't give me a clean guidance, but it seems to be organically moving towards more non-south contribution to the revenue. Therefore, can I assume that the volume mix will lead to margin expansion as well, organically, through this higher demand for studded?
Yeah, so when it comes to margin, there is going to be, because gross margin in our own store are only increasing, there is no pressure on gross margin. Okay, EBITDA margins are also strong. But if you look at the overall margin for the running financial year, it is only going to degrow because FOCO model expansion is happening. FOCO model, we share a bulk of gross margin with the franchisee partner, and our margin becomes lesser than the usual 16%, right? So there is going to be pressure on gross margin. There is going to be pressure on EBITDA margins, but that should not be the way we should look. We should look at the PBT margins because PBT margins are only going to grow, and the ROCE are also going to grow because it comes with a very capital efficient way because it's a FOCO model expansion.
Okay, fair enough. So then from that perspective, to set the expectations for your investors, what kind of range can we expect for all of the margins that you have just mentioned?
Yeah, so now we are at a PBT margin of around 4.8%. I'm not going to talk about EBITDA margins because anyway it is going to degrow, right? Gross margins are also going to degrow, because we are for FOCO model, right? When it comes to PBT margin, we are in the range of 4.7 to 4.8. It should climb on a consolidated basis. It is 4.3, 4.7, 4.8 India. So that should go near to 5 in the running financial year because the PBT margins are going to improve because of the FOCO model.
Understood. What is the strategy on the Middle East or the West Asia business? And I see that you've added only 3 stores from Q4 of the last financial year. Is there a plan to further expand, or are you satisfied with the kind of spread that you have right now?
No, there is actually, the market is very big. We have great opportunity in that market. So we wanted to test a FOCO model in the previous financial year. There was a slight delay in the plan. We will be testing the FOCO model in this financial year, maybe before the first half. Once that gets settled down, we will come back with an expansion plan for the Middle East. And the market is wide open. It's extremely big market, and we have a great opportunity. We are just waiting for the first set of FOCO model franchise to get settled down.
Now, if I speak about the jewelry business in its entirety here in India, the latest trade data seems to suggest that the demand is slowing down. You have imports of gold that have dramatically fallen, and that's, I guess, to be it's normal because the prices are where they are right now in the international market. Is that going to be a bit of a dampener in the first half? You said that you have strong same-store sales growth, but is the price going to be a bit of a dampener according to you in the first half of this financial year?
No. So when the price goes up suddenly, if there is a huge volatility, then there is a pause in demand, which was the case in March. But April, people saw that the price is getting stabilized and people are back to the stores. That is why we see high demand, we see high revenue growth in the first 45 days when compared to the previous financial year. And when you look at volume versus value, that will always be different because when the price goes up, the value growth will be there, but volume might not grow because people come with a budget. People cannot increase their budget suddenly because the gold price went up by 20% or 15%, right? So when the prices are high, volume comes down. When the prices are low, volume goes up. So that is how the industry is.
Fair point. My last question, any other non-core sales that you have lined up, or are you more or less done?
So if you look at the aircraft, the it is more or less done because there is no more write-off which has to happen because both the aircraft has been signed, and there is one more chopper in the book which is only a 30 crore valuation, which we will come back to you when after the closure of this transaction, which is going to take 5-6 months.
Sure.
Then we will come back to you on the plan for the chopper. But if you look at other non-core assets, it's majorly real estate which is there in the books. That comes out only if you repay your debts and negotiate with the banks to take out those collateral, right? And then liquidate it and bring back to your system. So that is a 2 to 3 year process. So for this running year onwards, we have come with a debt reduction plan. 40 to 50% of the profits generated, we want to make sure that we deploy it for debt reduction, plus payout of dividends, okay? And we want to reduce our gross debt at least by 15% in the financial year. That's our target. And it will be the target for the next 2-3 years. Once we start doing it, once we start negotiating with the banks, we expect to take out collaterals, which is non-core, it is real estate, which again we will liquidate and bring back to the system. Okay. So that is a 2-3 year process.
Just a follow up to that on the debt reduction plan, if I remember correctly, the net debt to equity ratio is not looking very high, and you've reduced it over a period of time, 0.7 right. If I'm not mistaken, right? So
exactly.
So yeah. what is driving the idea behind further deleveraging?
So because this non-core assets are there in the books,
sure.
The balance sheet becomes heavier.
Sure.
So it is not about the debt equity ratio. It is, as you rightly said, it is extremely what you call strong. 0.7 is not a what you call
an alarming number.
Ratio. Yeah. So we want to do it because there are a lot of non-core assets. It was the traditional way wherein we were actually getting loans from the banks in India.
Sure.
For our sector. Okay. So we want to lighten our balance sheet. That is why we are doing this, because otherwise, as you rightly said, it does not make any sense to save 9% interest when our ROCEs for new stores are in the range of 24-25%.
Yeah.
But we want to lighten our balance sheet. So we are working in both ways. One, we are going for an asset-light expansion, which is going to really increase your ROCE on a numerator point of view, right? And second, when we do a lightening balance sheet, the denominator is also worked on. So the ROCEs go up further. So that is the task for the next 2-3 years. We are going to do this way.
Are you moving to completely debt neutral position?
That is not the intention. As I said, actually, our intention is not to make it a debt neutral or debt free company. Okay, we start repaying the debt. We hopefully renegotiate with the banks. We take out the collaterals, or if the bank come up with a solution wherein without a collateral, if we are able to get loans, then we go back to loans again. So we don't want to stick with the traditional way of getting loans from banks.
Understood.
That's the only intention.
Understood. Ramesh, thank you so much for taking the time. Pleasure speaking with you. Always good having you on BQ Prime.
Thank you.
Viewers, do stay tuned. Lots more coming up over the course of the day.